You're struggling to understand options Greeks. Well, in this video, guys, I'm gonna make it super duper simple. There's really two major Greeks that you need to pay attention to, but we will review the big four. Delta and gamma are the ones that we focus on the most. If you are familiar with the whole GameStop thing that happened a few years ago, I actually rode that train. I made $480,000 on a nice little gamma squeeze. Things like that are all based off of the Greeks. So I'm gonna demystify that, make it super duper simple so that anybody can understand what they mean and make trading decisions, even if you're not trading options, but you can make trading decisions in maybe futures, which is what I trade, based off of what's happening in the options chain. Now, if you're new here, my name is Forrest. I am a day trader. I trade my own accounts. I also trade prop firms every single day as well. I'm using trade copiers across all my different accounts. If you're looking for a prop firm, check out MyFundedFutures. The link is down below. And there are other links to things like Apex. I have 20 accounts at Apex. You can go ahead and check them out with my affiliate code. There currently is a 90% off sale, but I think that is expiring soon. Cannot recommend MyFundedFutures enough. Great trading rules, great company. Check them out as well. And they're having a competition in March where you could win a free account, which is pretty cool. So let's talk about the Greeks at a high level. So first, what are they for? The Greeks just give us an understanding of how the price for an options contract is going to change. And I'm going to bring up the kind of textbook definitions here from Investopedia, which you can actually just go look at yourself, but I want to talk about them conceptually first as a trader, as a discretionary trader. So first and foremost, delta, okay? Delta is the amount of change in an option price for every $1 change in the underlying asset, okay? We'll use a very simple delta. If you have a delta of 1, okay, that means that every time the price of the underlying asset increases by $1 or decreases by $1, depending on if it's a call or a put, the price or the premium and price are the same, of that option contract will change by 1, a value of $1. Same if it was 0.3. So 0.3 delta means 30 cents. So if the price of the underlying increases or decreases by $1, then price of the option contract would change by 30 cents, 0.3. Cool. So what's a situation where delta would change? Well, an increase in volatility on its own can change deltas. This is super duper critical to know as a trader. You can make money just due to an increase in volatility, which is one of the coolest things about options. You can also lose money just due to an increase in volatility, right? Implied volatility, what we call IV, you can just look at it in any broker. There's always some area somewhere. There's a summary per contract, and then there's a summary on the entire chain where we can look at these things. I started with this before we get into the definitions because I want you to keep that greater concept in mind when you're actually making trading decisions, because we're going to go through the definitions here. There's some math that you can always do, but as a discretionary trader, what you really need to know is that you have delta, which is the amount that your contract is going to change for every $1 change. And then that delta is directly impacted by IV. And say you buy a contract with a delta of 0.3, some crazy news, maybe like some AI news drops, and the deltas jump up to 0.6. Price also moves, but what's really cool is that you're immediately making money on your contracts just due to a change in delta. There have even been times where I've made money on contracts where the price is flat simply because IV is increasing, or expected IV, which is Vega, starts increasing. But let's actually jump into it. And I gotta open my laptop here. I want to give you guys the official definition. I do know what these are off the top of my head, but I want to give you the official definition. What are the option Greeks? And I encourage you to do this. We're going to read it off of, I'm not going to like rehash some twisted new version of standard information, guys. I'm not going to do that. I'm going to provide context around them and how to use them as a trader though. So we're going to use the definition that's on Investopedia, and I'll give you some context about how to think about them as a day trader deal. And again, going back to the beginning of the video, you can even rewind it. Delta is very important. The second one, gamma, is very important as well. Let's go back to the top here. So that you see that they have delta, gamma, Vega, and Theta, and they're missing an A on Theta. So delta is the measure of the change in an options price or premium resulting from a change in the underlying asset. Gamma measures the rate of change of delta. I gave this example in my last video, but delta is speed, gamma is acceleration. We'll pause there and let's talk about that for a moment, okay? Am I recording my screen? I am, okay. You're going 100 miles per hour. For the past hour, you've been going 100 miles per hour. That means that you've traveled 100 miles in the past hour, right? You went 100 miles per hour for an hour. You hit the accelerator a little bit more, okay? You're going from 100 miles an hour to 110 miles per hour. How fast you went from 100 to 110 is gamma. That's acceleration. That's what you're measuring. You're measuring the rate of change of speed, which is acceleration. In the options chain, call that gamma. Okay, gamma measures the delta's rate of change over time, as well as the rate of change in the underlying asset. It helps forecast price moves in the underlying asset. So we talk about things like gamma ramps. As gamma starts to increase, you have a faster increase in delta. That's like you barely press the pedal. But what happens if you just push it to the floor? Your rate of change, your speed of change increases. So you're going faster in both situations, which is what I want to call out. You push the pedal down slowly, you're speeding up. Push the pedal all the way down, you're speeding up. But it's not the same. You're speeding up, but it's not the same. Okay, that's what gamma is. Same with hitting the brakes, but we'll only measure in one direction. We'll talk about both directions later. Vega measures the risk of changes in implied volatility or the forward-looking expected volatility of the underlying asset price. I talked about this just a second ago. So Vega is a measure of change in volatility, or it really says the risk of changes in implied volatility. Why is this important? Okay, so another way to think of delta, and this is mentioned, I think this is mentioned somewhere in this article, I've looked at this thing a few times at this point, is the chance that a contract will go in the money at expiration. Okay, which, yeah, let's just talk about that because I don't want to lose that train of thought. So if you buy a contract with a delta of 0.5, there's a 50% chance that that contract will go in the money at expiration. For a contract to be in the money, again, the strike price has to be above or below the actual underlying price, depending on if you're in a call or a put. So if the current price of Apple is at $95 and I buy a $100 call, then Apple needs to be at $100 or higher for my option to go into the money. Okay. Puts is the inverse. You're betting on the price going down if you buy puts, betting on the price going up if you buy calls. Vega measures the risk of change in implied volatility. In that example I just gave, there's going to be some delta on those calls that I bought. How do I measure the chance that the market is going to suddenly have an injection of volatility? And what is volatility? That could be, there's 1,000 people at an auction and then suddenly 5,000 people run through the door. It's going to get erratic. That's what market volatility is. Suddenly there's just way more participation, price discovery gets erratic. However you want to think of volatility, I usually think of it as increased participation. That tends to be what it looks like. There can be other things that cause volatility, like, an executive, that's going to inject volatility. Measuring the percent chance of that is what Vega is. Again, an increase in volatility will increase your deltas. Okay. Why? And think about it. Think about why would delta increase with increased volatility? Well, delta is the percent chance that it goes in the money. If the volatility is crazy, odds are it might go in the money, even though we're super far away from it, because now we have an increase in participation. Starting to see how it all is connected? That's why the deltas go up. It's not just magic. It's not because it's math. We're not looking at any math on the screen. Delta is the percent chance it goes in the money. Vega is a chance that volatility increases. So volatility increases, the chance that it goes in the money increases, right? Why? Think of the example, because a ton more people showed up at the auction. It gets crazy. Now there's more, anything's possible, especially when you have more participation. Theta is the measured time decay. Okay. So probably heard of theta decay before, dabbled in options. Options are designed to expire worthless. Okay. So just like there's a 50% chance using the 0.5 delta example, there's a 50% chance it doesn't go in the money. Eventually that contract's going to go to zero. It'll be worthless if it expires out the money. Okay. So every contract you buy, if you buy it for $10 and it never goes in the money, it's going to slowly approach zero. The amount that it loses every day is theta. Okay. So let's scroll down a bit and let's just look at some examples here. So they give an example of delta. This is the one that I just gave. What I want to really talk about here is these three changes here. So delta tends to increase closer to expiration for near or at the money options. Let's just say zeros. So a lot of people play zeros. It says delta tends to increase closer to expiration for near or at the money options. So on the day a contract expires, so close to expiration, and if they're near or at the money, deltas increase and decrease faster. It says tends to increase, but goes both ways as you move further away. Delta is further evaluated by gamma, which is a measure of delta's rate of change. So gamma is the same. I talk about on my stream a lot in our Discord. It's called Trade Edge, by the way. If you want to see us talk about this live every single day, I know I'm doing it in the video. Call this stuff out live every single day in our Discord. We have a 7-day free trial. Check it out. The gamma trades that I'm talking about is when you catch a rapid change in gamma, which really is quick change in deltas, but when gamma goes from a very low value to a high value, forces the deltas up quickly, and you can get the nice 400% or 500% wins that we get a few times a month. Delta can also change in reaction to applied volatility changes, end of day price action. On zeros, market gets erratic. Volatility spikes even just for a moment, causes an increase in premium. I want to call that out as well. So there's a breakdown of gamma here. I don't want you to focus too much on this other than thinking of it as the rate of change of delta. The most important thing about gamma is understanding that if you plotted it, it is a ramp. Okay, there's a gamma ramp and it has an exponential pressure on prices. So as you move higher up the ramp, gamma increases, and remember, gamma is the rate of change of delta. So if you're going faster, even faster, and then you go faster, even more faster, think of it as like you're in a car. It's like the pressure on your body going up and up and up. That's what gamma does. You can plot it if you like. You don't need to go that deep. Again, I'm really focused on how to think about this as a discretionary trader. Find a contract at a 0.3 delta on a day, low gamma. You can actually track the gamma for every change in price. Look at SPX, every one tick change in price. You'll see how it starts to affect the deltas. Theta measures the time decay in the value of an option or its premium. Okay, so if you have a contract, what does that mean? If you have a contract that's $5 and has a theta of 1, that means that after a day, all other things flat, it'll have a value of 4. It's going to lose $1. If it has a theta of 0.3, that means it's going to lose 30 cents. Okay, when you're looking at zeros, just understand it gets hard to calculate intraday, but just understand any contract that's out the money for a zero is going to be worth $0. That's how you calculate theta. I will tell you from experience, and you can experience this for yourself, any contract you buy in the morning, by noon, 1 p.m. is going to experience an insane decay due to theta, okay? Because the odds, even with volatility of it ending up in the money, are exceptionally low. So all of its time value is going to deteriorate. That's another example of time value. So if we go further out, let's say I want to buy a contract today that expires in June. The odds of that ending up in the money are hard to measure because it's so far away. It has a ton of time value. That contract has a ton of time value because within that window of time, a lot of things can happen. As you get closer to zero, it has no time value, right? The chances of this contract going in the money are basically zero. So its time value is going to approach zero. All that's going to be left is the intrinsic value of the contract, which at that point is also zero. Once the contract goes in the money, it still has no time value. I want to call that out. All of its value becomes intrinsic value if it goes in the money on a zero-dated contract, which still can go up exponentially as they do, but there still is no time value. This is why when I'm trading zeros, and this is where we get to the context about this, I'll give you some examples. You're trading in the morning. People trade zeros in the morning, try to catch like the 10 or 10:30 move. That move comes and they will hold these contracts. And what's going to happen to their position is you'll get a nice 400 or 500% change. And I chart these premiums. I actually have a bot that I coded where you can chart premiums for any given contract on a day in the Discord. Check it out. Spend a lot of time coding that up. You will see a spike in premiums due to the first move, and you will see them drop off exponentially. Why? Theta. Okay. So you get a rapid change in deltas due to a nice little gamma maneuver, quick change in prices. Market consolidates, but the odds now for any contract that's not in the money, and even contracts that are in the money, they have to erode their time value. So if you have a contract that goes from $3 to $9, you need to take profits. That's a summary of this little few sentences. I'm saying you need to take profits. Why? Because your contracts, as the market is consolidating, it has to burn off that time value. Okay, so your position that went up 300% from $3 to $9 literally will go back to like flat in a matter of like 30 minutes, if not faster than that. I've seen it happen so many times. I've experienced it when I first was a newbie with options. Do not hold your zeros. Okay. The flip side of that, Forrest, when should I hold zeros? Okay, let's talk about when you should hold zeros. The only time you should hold zeros, in my opinion, is when they don't have time value, which is why I like end of day gammas. Okay, so there's two options. You should always take profits in any zero dated trade. I'm gonna tell you that. Take profits after the first move. Most time the first move is the move on an option contract. You'll get a move, and then if you have a thesis, a greater thesis that's gonna play out later in the day, very often than not, you can get those premiums at a cheaper price. So there's no point to hold those anyways. Only time you should really hold a zero, and I'll say this again, the only time you should hold a zero in this diamond fist of zero is when they have no time value. The only way to get a contract with no time value is near the end of the day. I'm gonna be honest with you, that's my opinion, okay, in terms of like a setup option trades. There's many different outliers where you bought something in the morning and the market goes crazy. So despite the fact that it lost all its value, it ends up in the money later. But like I said earlier, you could have gotten a better entry anyways. Okay. So there's no point to hold through all of that. There literally was none. You got lucky basically, right? There's very rare cases where a thesis like that plays out where you couldn't have gotten a better expiry. If you want to hold that long, I recommend that you go further out, go like 7 DTE, 14 DTE, 1 or 2 weeks out, right? Go a month out. Why? Well, because you're still going to get changes in delta and gamma. It's not going to be as exponential on either side though. You can hold longer. What will happen is for a lot of day traders is that your thesis will play after settlement. This is something that I see happen very often, in which smokes people on zeros. They're like, oh, well, I'm trading ES, for example, and I think that the market's going to go up to to this other major level. They pin it at close. Then right after settlement, the move happens. So all those options become worthless. You were right. Your TA was right, but you were off by a day. So you can buy time. If you're new to options, I recommend not playing zeros. I'll just say that. Don't play zeros at all due to all the aforementioned. And if you're watching this video and you're like, holy crap, this is more confusing than when I started, it's really not. Just keep it simple. My recommendation for everybody playing options is, and this is why I trade futures, right? I literally only traded options up until last year. I started trading futures a little over a year ago because futures are a linear product, or you have linear gains. So it's hard to, you don't capture that asymmetric risk, but all the TA and everything is the same. So my recommendation is trade options like you would trade futures. Identify the trade, do your macro analysis. When the market hits your price target, get out. Get out! Just take all your profits because your 180% isn't going to go higher. It's not. And if it does, it doesn't matter. There's another trade. You got an asymmetric outcome, which is good, right? You did far better than you would on a futures trade. I do both nowadays. I trade futures and I do options, but I'm very, very tactical with my options now. And I always keep in mind that the market, more likely than not, isn't going to give me a crazy return. Hitting 300% on a trade is an insane return. Hitting 150% on a trade is an insane return. That's a great ROI on a single, binary trade. And you just have to accept that. The problem with options is purely psychological, like everything else in trading, is that people always want the 700 percenters, 14,000 percenters. They want to replicate what happened with GameStop, where I turned 8K into 480K. It's not going to happen, guys. And if it does, it's not going to happen for you. Okay. So stop looking for those things. And instead you'll literally make $480,000 faster if you want those crazy returns by just managing your risk appropriately. I can tell you from experience, you will do just fine if you just trade normally, stop burning up capital on these big hits. And if you just make good money every single day, it snowballs exceptionally fast. So do that instead. Whew. So that was my breakdown of the option Greeks. Let's do a quick little recap about how to think about this. We talked about Delta, we talked about Gamma, we talked about Vega, we talked about Theta. Delta is the amount that your premium will change for every $1 change in the underlying asset. Gamma is how much delta will change for a change in the underlying asset. Okay, so how fast will a delta of 0.3 go to 0.6? Vega, I couldn't think of the next thing on the list. Vega is the risk of a change of implied volatility, something to keep in mind if you are being exceptionally speculative and possibly want to hedge. If you are a premium seller, for example, or something like that, you definitely want to account for changes in volatility. You also want to pay attention to changes in volatility when you're buying contracts. Buy a contract when volatility is very high, even if the price, and this is actually key, I should have said this earlier. If you buy contracts when volatility is exceptionally high, even if the market goes in your direction, you can lose money because a lot of the value is due to a chain or is due to increased volatility. We call this IV crush. Okay. You buy, look at any of the things on Wall Street bets, SMCI, all these different tickers, they go exponential. People will buy puts and still lose money on the pullback because the IV is off the charts. All the value is in the volatility. So it doesn't matter if you are directionally right because you got in too late, right? The IV is too high. So IV just gets crushed. It comes off exceptionally. And so those contracts lose value. So watch out for that. That's part of the reason, by the way, why people made so much money on SMCI, for example, is because of the increase in IV. It's not just the price. Obviously, options going in the money is huge, but it was the increased volatility due to the way the chart looks. People FOMO in like monkeys, and that's retail trading. The last one is Theta. Theta is how much value your contract is going to lose every single day as it approaches expiration. Pay attention to this, especially if you're trading zeros, which I wasn't trying to make this focus on zeros. I just know that 99% of you are going to trade zeros because you're on YouTube looking at day trading information, and that's the type of people that we are. So I'm just going to keep it a stack with you. I'm just recognizing who I'm talking to. I trade zeros. I day trade 70 TE and 2-week expiration options a lot, guys. And I recommend you do it too. I do trade zeros, but I'm going to say that again. I trade 70 TE, 2-week DTE options a lot. Okay. Day trade the further expiries. You will be exceptionally surprised at how much of an ROI you can get on something that's far away because all of the exponential gains apply even when it's not a zero. Gamma ramps, increases in volatility, all of that applies even on further dated expiries. It doesn't apply as much? Theta. You're welcome. Thank me later. And that's it, guys. There are other smaller derivatives that you just don't need to account for. If you probably are much more interested in math, and I'd love to talk to you on my Discord. We'll save that conversation for there. And on a YouTube channel, I am an academic myself. I love plotting this stuff and looking at all these things. I don't think they're too useful though as discretionary traders. Most of what you need to implement is risk management and understanding the risk to your premium, right? As you get in and out of positions. But please subscribe to my channel, like this video, share it with 2 friends, and hopefully I'll see you in Trade Edge. If not, see you in the next video. Peace.